Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it. It's generally related to three different topics: wealth building, commodities, and/or financial topics. So we're going to dive in there, take a look, see what people are sharing, and I'll share my opinion as I go through it. If you want to follow me, it's at funny_finance. And if you want to join our community, finding-value.com, where I dive deeper into all of these topics, looking for investment opportunities for individual companies. And it's mainly across the commodity space because that's where I think the value is and where I think explosive upside potential lies when we get moving again. So starting out with Ted, he says HYG, JNK, and LQD, which is corporate bonds, breaking out into new 52-week highs before equities indicates a risk-on environment. In a risk-off environment, credit spreads increase, meaning junk bonds are sold off. This is not the case now. So there's two things I want you to grab from this chart. Number one, the environment when these bonds go up is risk on. And number two, this chart pattern is absolutely beautiful. It is a double bottom. In stage analysis, this is stage 4 decline. Stage 1 bottom, it's that double booty bottom that we look for. You generally draw a line across the top as resistance. That becomes your support when you break out. Your back test of this red candle to this white line here, that's your ideal buy point when using technical analysis. And here we are breaking through resistance to the upside, indicating that we are entering stage 2 of the move. So that looks really good I mean, this is like as clean as you can get for a chart pattern. I mean, as clean as you can potentially get of anything that I've almost seen. Now, Matt says futures markets is pricing a 3.25% Fed funds rate by September of 2026. I think something like that is very possible. What this is, if you go all the way back to 1982 where it peaked, you draw a trend line across and the trend line goes down like this. I think we'll get the pullback just like they're saying, and it's going to be a higher low. So you get this high here. We're going to go above that. I don't think we're going to go all the way back down there. If we do, it's going to be support. But yeah, I think this is real close to where I think it will end up for sure. So it'll be a higher low, and then we'll work our way on up higher. Why do I think it's going to go higher after that? Well, I think the housing market's going to kick back on, and we may even have to go higher quicker if the housing market kicks on fast enough. And it depends how fast and how low interest rates go will also depend on what the housing market does. If we do not see a response by the housing market with decreased interest rates, then it's time to worry. You need to start looking at U.S. construction all employees numbers. If those numbers start to drop, that is generally when a recession, a bigger recession comes. It's when you lose employment from residential construction, all employees. Correlation economics, listen to the Canadian dollar. We've been watching currencies, Canadian dollar, Brazilian real. There's other ones too, Great Britain pound. These are all going to break to the upside, I think. And they're going to break when this gets lowered here. So what we generally see is we see weakening in some of the other currencies first in terms of monetary policy. Then monetary policy in the United States will come down and it's going to raise these currencies up, I think. In the last kind of big commodity bull market, the Canadian USD ran from 2002 all the way to the peak of 2008. It was the dollar that was declining, causing the commodities to go higher. It's dollar. And we saw a whole bunch of emerging markets go up. Canadian dollar went up during that time frame. He also has oil here, and oil is consolidating much like Canadian USD. Now, if you look even closer, you can draw a trend line through here going across. That trend line indicates that we've got a bottom 1, a bottom 2, Draw the trend line across. That's your ideal buy point is off these guys here, which of course I didn't miss that. We could tap it one last time if there is a bigger slowdown or something, some sort of event in the market. But overall, this is going to enter stage two, wave three, stage two, two different things. Stage analysis, stage two, and Elliott wave, wave three, perhaps. We get a big move to the upside. So it's coming, but there might be a transition between that move and then when this gets sold off, we could see a potential slowdown as it drops. We have to see if the economy is strong or weak when they lower this, because if it's weak and they're lowering rates because of a weak economy, we would see a sell-off. If they're lowering rates but the economy is strong and they think they've got inflation under control, well then I think we could see it go up, the oil price go up. And I'm looking at the housing starts as a leading indicator to see if the economy is strong. As they lower rates, we should see, I guess, that home builders and housing starts go up. And home builders have been going up, not down, which signals to me that they're lowering into strength, not weakness. Or at least the market is front running what they see as strength. We're in the cycle, the Banana Republic stage. So on Wednesday, the Bureau of Labor Statistics will downward revise jobs for the April 2023 to March 2024 period by up to 1 million jobs. This means that all the beats recorded in the past year will have been misses, and the US job market is in far worse shape than the administration would admit. Are we really contracting? I kind of feel like we are, and we're shedding jobs over in the tech sector, and maybe the weakness is behind us. Maybe. Tough to say. Here's home prices adjusted by money supply. I wanted to share this. A lot of people talking about home prices never being, they were never this affordable and all this other stuff. Well, let's just see what are home prices if you were to take the money supply and adjust it by the money supply. Well, I can tell you this, in 04, 05, 06, home prices were far higher than what they are today if you adjust it for how much money is in the system. That doesn't mean that it makes homes more affordable because that money obviously isn't distributed evenly throughout the system. But the beginning of 2000, home prices adjusted by the money supply are far more expensive than they are right now. Everybody gets so confused because they go off of the price in dollars. This is the whole reason I do ratios and why I stick to ratios, because ratios tell you if it's expensive relative to history or not. This right here is telling us that the house prices have not adjusted for the money supply in the system yet. Coming down to uranium corgi, it is it Monday yet? Looks like $500 a pound uranium is back on the menu, boys. And he's talking about CGN warns with a profit warning of the new situation in Kazakhstan regarding taxes. No more cheap uranium coming from Kazakhstan. It's over. Um, $500 a pound, I think, is doable. I really do think it's doable. I also think oil is going to get up there too. I think oil and uranium are going to be priced similarly. Previous bull markets, we've seen that correlation where they are real close in pricing. And I think that's going to come again. Late 2020s, if you want my time frame. Oh my God, I remembered seeing this and have been looking for it everywhere for the last month. What do you notice about the supply demand for the next few years? This is the global supply demand for HCC will impact economic development and the energy transition. Supply versus demand. So that is your met coal prices. 23, 24, we're a little bit, it's a pretty balanced market. And then we get into a larger imbalance after 2027 or so. Most commodity charts look far worse than this one. If you look at commodity charts like copper, oil, graphite, lithium, any of them, They look ridiculous because the gaps between here and uranium too, they just blow out in everything that is commodity related. So I don't see how we don't get into a large commodity boom coming up here in late 2020s. I just don't see how we would avoid it. With the debt crisis that we've got and the money printing and credit creation, it's going to amplify the supply problem. So whenever you have inflation or credit coming to the system, that is AKA your demand for commodities. Credit creation is going to be commodity demand. And that's where I think interest rates, they're going to come back. They're going to increase the price of homes, I think, and bank lending, which is AKA credit in the system. It's going to be more demand for commodities and it's going to expose that problem, which makes me think that this has to go back up. Coming down to double bottom on gold versus the S&P 500. There's that double bottom that I'm looking at. And this is just gold divided by the S&P. That double bottom, that's exactly where we want to be looking. We have a lot of upside in this. This is the S&P 500 versus the M2 money supply, and I haven't looked at this one in a long time. If you look long term, this goes all the way back to the 1960s. The 1960 on the left over here goes all the way across. We really haven't made the S&P has always been restricted by the M2 money supply. We've basically been going around, quote, the average area here, and we swing from undervalued, like 1982 is where I would have purchased it, and that's where all my buy points would have been. The sell points in the commodity shift was in 98, 99, which is right here. You'd have been buying commodities here, and then you come all the way back down, commodities sell, and buy the S&P again because it's low. Then you come back up, and we're at the upper end here. That is why I think that this is not a good buy for the S&P 500. I think we're in a bubble. It's overvalued, and you can value it against the M2 money supply and how this swings back and forth. I do think this is going to swing lower, and commodities outperform when this goes down. The different market condition, and it's coming where commodities are going to outperform. Mike Sicardi says, also helping markets along is rate cut speculation. On that note, next Friday, Jay Powell speaks at J Hole on the economic outlook, and odds are he will look to prep things for a rate cut. The real estate, utilities, and materials are most sensitive to falling rates since the start of the Fed's hiking campaign since 2022. So real estate's the most sensitive and has been since 2022, and upside beta to TLT. We're actually positioned for this, some of us, on the website. Here's one. As the koala has said to many of you this year in person, China isn't the question anymore for most commodities. It is what it is, but unless you want to call a collapse, not where focus should be. Southeast Asia, Indonesia, India, then Africa. That's the growth markets for the next 5 to 15 years. This is global export met coal demand. And it says India projected more than triple export met coal demand by 2050. So that's where the big demand is coming from in terms of met coal. And this is 2024 in the projected increase for this commodity. The SOM rule doesn't work very well outside of the United States. So this is the percentage of successfully predicted recessions. So the big countries, Japan, Switzerland, US, pretty high. Then you get down to some of these smaller, Canada, Belgium, and UK, and the percentages are actually quite low, under 50%. It's projecting, or under 50%, it's been right. Just an FYI. Rick Rule rhetoric, he says, the truth is that we needed to be investing in copper capacity 30 years ago, and there's simply no way in the next 10 years that we're going to be able to catch up. Totally agree with that. And that's where copper, I'm just trying to think of who's going to make all this money in the commodity complex. Where are the largest deficits at? And is everything going to flow upwards? So what does that mean when I say flow upwards? Well, copper's downstream from other things. If we have a shortage in coal or natural gas or oil, that means that the profits are all going to roll up to them because they're earlier in the chain of inputs. Copper's kind of more towards the back end, and then obviously on the way back end are finished products that the S&P 500 companies sell. So they would be the worst because they'll be disrupted the most. And then money flows upward if the problem is in front of you. So if the problem is copper, then the companies that consume copper, it's going to be a problem for them because the price is going to increase. And or they can't get the actual physical metal because it's that short if it becomes that short of a problem. Or people get priced out. Probably a combination of all those things. But copper, yeah, it's a huge problem. And what I see with copper is the ore grades are so low now that it's going to have extreme impacts on energy consumption if we want to try to ramp copper production. Lower ore grades, lower concentration of the ore, so smaller mines. And when you sink a bunch of money into a mine, it's going to be distributed over less reserves. So the cost of those mines are going to increase. And with the lower ore grades, you're going to have a lot more energy input too. So if we're going to try to increase and ramp copper, I just see that as more energy demand, lots more energy demand. Here's BitPayne. He says, I think the diminishing in Bitcoin since 2013 is almost solely a function of crappy coin market and dumb money. Zero value projects like Doge, BCH, Solana, and Ethereum still collectively have almost 1 trillion in fully diluted market cap. This is perhaps the most insane overvaluation, not in absolute, but certainly in relative terms, in the history of the markets. The slow churn of these projects towards zero not only enriches their founders, but actually destroys invested capital. Should this capital have simply been accreted to Bitcoin dominated savings on the margins, I suspect we would be at least 3 times and perhaps as much as 10 times higher in terms of USD denominated BTC price. So this is this guy's opinion about all the other coins that are outside of Bitcoin. Now, my opinion is the same opinion that he holds, but mine's with Bitcoin. It's funny. These guys look at all the other coins and they clearly see that they are garbage. They're like, why would you go into any of these? They're all crap. And then I look at Bitcoin and I say the same thing. I'm like, why would anyone go into Bitcoin? Because it's literally it's nothing. And I'm sitting here scratching my head. It's like, how do these people see this, but they don't see it in Bitcoin? Is it because they own it? Like, I don't understand what the difference is here. How they can see it, but Bitcoin, oh, that's the best. I don't understand it. I think they're all crap. SRS Rocker Report says, like most Grant overlooks the fact that the world is driven by energy, which is completely true. With the most critical high energy return on investment energy source, conventional oil production is now declining. Treasury and financial collateral will come into the question. I totally agree with this. This is where I always had my mind at. Treasury and financial collateral will come into question if you have a problem in energy. It says this is when the market will understand what provides an asset, its value, and its energy. Gold and silver miners provide the highest quality collateral due to the high cost of production. However, the US Treasury can print trillions of additional treasuries at little or zero cost. While the market continues to absorb US Treasuries as the foundation of collateral in the system, this gets into serious trouble as the world heads over the energy cliff. With above ground silver inventories only double that of gold, the ability to protect wealth in the future is real collateral will force more investors into silver, which again has a very limited supply only at much higher prices. So let me describe so people understand it. Energy is the backing of the system. It's not, the real collateral is not US Treasuries. US Treasuries, in effect, is the ability to print something and then you gain interest on it. The final payment of dollars is a physical item, like it's designed and manufactured and it uses commodities. So it's either the final design product or the commodities and natural resources that go into making that product. All of those things, the gathering of the commodities and converting those commodities into usable products requires energy. The whole system does. So ultimately, what a treasury and a dollar bill is a future claim on energy. That is what it is. It's a future claim or a future repayment, like a final payment in the system is either a commodity or a final product using commodities. There is nothing else. Or you can buy land, but that's more or less a commodity, is what I'll call it. But land, oil, copper, whatever it is. So when the world figures out, and if we get into a situation where energy becomes scarce, people are going to question the entire bond market and currency market. They could implode because the backing of currencies and also the bond markets is really energy. And if energy gets scarcer or goes down, that means that GDP goes down. It's your ability to pay back all of these bonds. And that's where the problem lies. And he's completely right with that. And that's where we're going to end it, guys. That's what we've got for today. So give me a thumb up for the content, subscribe to the channel, subscribe to the website. Still active if you guys want to join. And that's all I've got for today. So we'll catch you later. This is Finding Value.